Good afternoon. Good afternoon. Welcome in for another edition of the financial seminar. It's been a phenomenal week. And first of all, let me thank everyone for tuning in all week. We have had such a time from Monday to today. Today will not disappoint. I promise you, as I've been telling you all week. Make sure you have your pen and paper ready because I'm sure you're going to get some vital information on different ways that you can put your money to work and allow your money to work for you. Um, Please feel free, as we've done all week, ask questions in the chat. As your questions come up, I'll make sure to present them so that we can get them covered. Feel free. It's a no judgment zone, so feel free to present any question to the full that you have. I promise you, somebody else in the chat, 9 times out of 8, probably has the exact same question that you do. So make sure you drop questions today. We are going to cover your investments and all things surrounding investments. We want to make sure that we are equipped to do all the things that we want to do. We want to make sure we open the door to us being able to have the same advantages that others have. So here's the perfect forum for you guys to go ahead and gain that knowledge and information. Today we're going to speak with Abraham Tenna. I will go ahead and give you guys a little background on him. He's a graduate of the University of Florida, Go Gators, you guys know, where he obtained a Bachelor of Science in Accounting. Mr. Tenna also earned a Master's of Accounting and a Master's of Business Administration with a finance concentration from the University of North Florida, and he's a certified public accountant. He has a thorough understanding of finance and accounting gained through direct job experience, training, and education. Industries include, but are not limited to, following both private and public company settings: financial services, banking, manufacturing, retail, professional services, healthcare, governmental, transportation, technology, and logistics. So his resume is pretty in depth. I could keep going, but I'll stop right there. His resume is pretty in depth. But without further ado, I'll bring on Mr. Abraham Tenna. Welcome to the party. And we will go ahead and kind of get started from there. Hey, welcome. Thank you so much for joining us today.
I appreciate you having me. I'm humbled and honored for the opportunity.
For sure.
We can go ahead and get started into the presentation. As mentioned, if there are any questions, happy for you to throw those in the chat. We can talk through them, and we can make sure that everyone gets what they need out of today. So today we're going to talk about putting your money to work for you. If you go to the next slide, what I want to cover, and I know that we've talked through budgeting and so on and so forth, but I want to kind of just highlight the budgeting basics, and then also talk about an emergency fund and how we can invest our emergency fund. And then after we have an emergency fund, what we're going to do from an investment standpoint. So I've highlighted what I think are kind of the 7 types or the 7 best type of investments to diversify. So we're talking bonds, stocks, mutual funds, ETF, real estate, crypto, and then commodities. If there are any questions outside of that, just let me know. Happy to talk through any of those as well.
Okay, for sure.
All right, next slide. All right. So what I'm looking at here is that we're taking our total monthly income from a budgeting perspective. We're going to then take away fixed expenses, which are typically rent, mortgage, and insurance, and then variable expenses like groceries. One thing I do want to highlight, though, is that you should always make sure that you have your tithe and offering as the first fixed expense.
Definitely.
Like, you got to make sure that you're giving God what is due to Him first. Absolutely. And then that's how your blessings actually flow as well. So I just want to make sure that as we're thinking through that fixed expenses component, that we're thinking about tithes and offerings.
Okay.
Then when we get to that disposable income, we can then talk through from that standpoint what we do with that. So if we go to the next slide, once we have that disposable income, we want to make sure we have an emergency fund. So the concept of an emergency fund is to have 3 to 6 months of those total expenses available. So therefore, if you had anything that happened with a car, with a house, with anything that you need financially, you don't have to actually go into an investment. You're not actually having to sell a stock. You're not actually having to look at a bond or liquidate something because you already have that emergency fund available.
So just for clarity, you're saying, so on the first page, if we can get back to that first page just for a second. So on the first page where you said your fixed expenses, so you're saying the total amount for all those all those expenses, rent, mortgage, insurance, loan, utilities, all those. You're saying have a pot set to the side, at least if we can, you know what I mean, in that 3 to 6 month range with the total of those things right there.
Yeah, but so both fixed and variable. So you're gonna
Okay.
have, so you got rent, mortgage, utilities, all of that that's fixed. Then
Okay.
groceries, home repairs, entertainment. You're going out with this person or that person on.
Okay.
You like to have seafood Fridays, or you like to go out on Saturdays, right? Put that into the budget. I mean, that's what
Okay.
it's for.
Okay.
So make
Gotcha.
sure you look at both. So when I'm saying total expenses, I'm looking at both fixed and variable.
Okay. Perfect. Okay. All right.
All right. So when we look into this emergency fund, typically a financial advisor, financial planner is going to say 3 to 6 months. One thing, a lot of questions that pop up is, should I have more closer to 3 months, or should I have closer to 6 months? Well, what I say is, if you're in a situation where you have to kind of pray for your car to start, and you have to pray for your car to stop, and you got a lot of, you haven't maintained your home, you haven't did anything like that, then you probably need to be at 6 months, just in case something were to happen, you have more of a pot. If you have a newer car, if you have a newer house that's under warranty, a car that's fully under warranty or something like that, then that's probably more to the 3 month period of time. But having somewhere in between, so again, as mentioned, if you have an emergency, if you have something come up, you're not actually going into a investment like a ETF or a mutual fund. You're just going into that emergency fund.
Okay. Okay. Okay.
All right. So when we're looking at that emergency fund, I just want to give a couple, just highlight a few investment types that you can look at from that perspective. So you can always put it into a savings account. I say savings account versus a checking account, because your checking account usually doesn't provide you any interest. A savings account or traditional savings account will give you interest. If you want to go up to a tier higher, let's look at money market accounts, especially while rates are rising. Money market accounts are kind of in that 3 to 6% range currently. Money markets give you a component of both a savings account and a checking account. They usually limit the number of withdrawals out of a money market account to probably 5 or 6 per month. But again, we're talking about an emergency fund, and we're looking to try to get as much interest and build onto that fund as possible. Another component is a certificate of a deposit, or CDs. Currently, CDs are yielding anywhere between 4 to 5%, some even higher at this stage, just due to the fact of, again, increasing rates. So I think if you're not attuned to the market or what's going on, the Fed just raised rates yesterday by 25 basis points, or a quarter of a percent. So that means that these money markets, these certificates of deposits, they're actually going to start increasing in the rates that we're seeing as well.
Okay. All right. So let me ask you this quick.
Yeah, go ahead.
Just quick. So if somebody had a simple question of what you just listed, in your opinion, what would you say would be the best for, let's say, somebody starting from square one? All right, I'm brand new to this. What would you say would be, and I want to use the term safest loosely, but what would you say would be
Sure.
the best avenue right here? Can you hear me?
I would say, if you can have, from an emergency fund, you're starting up, let's say you have $500 or more, I would say kind of the safest one to go to is a money market account, because you're still
Okay.
going to be able to have the funds within the money market account. You're still going to have a pretty good rate. Again, money market is probably 3 to 6% currently. And then if there's anything outside of that, you don't have to worry about any type of penalties or anything from a money market standpoint. So I think if you're just starting out, the money market is definitely probably the safest way to go.
Okay.
To put your money.
Okay.
You also got high yield savings and checking accounts, and this is where rates are going to be very similar to CDs. A lot of institutions that have the best rates are non-brick and mortar, so you're not talking about your Wells Fargo or your Bank of America, but you're really talking about places like SoFi. You're talking places like Goldman Sachs. Goldman Sachs, there's a lot of advertising now for Marcus through Goldman Sachs. You're also talking about Barclays, these type of places that are mainly more internet type banks. And because of the fact that they're not brick and mortar, they're able to give significantly higher rates. So again, just another method that you can use to invest your emergency funds.
Okay.
And then lastly on the list is a short-term debt fund. This is very common internationally, especially in Europe. But if you have the opportunity to invest in a short-term debt fund, they're usually pretty good. Is you providing money. It's very similar to a mutual fund, and we'll get into a definition of a mutual fund here a little bit later. But it's similar to that, where you can invest into kind of a pot of money that a fund manager is investing into debt, and gaining interest for it. And if you need to get out of it, there's not a penalty, and it usually takes only 1 to 2 business days to do so.
Okay.
All right, next slide. So I like this scripture, especially as we're talking about this in a spiritual form. Wealth and riches shall be in his house, and his righteousness endureth forever. So as we believe the promises of God, also as we believe as the leadership has stated, I think this financial seminar, financial forum, what Pastor Matthews is doing is very good, especially for the Black community. And so as we follow that leadership, as we follow that advice, God will definitely bless us, and he's promised to do so as well.
For sure.
All right. So as noted, we have our emergency fund now. Now we're looking to invest outside of that. We're looking at the best investment outside of the emergency fund, what we're going to do with a little bit of extra money that we have, or what we want to do with, let's say we have a 401k, let's say we have an IRA, let's say we have something like that we're looking for a retirement purpose, and we're looking to have that to grow. So we're going to look at bonds, we're going to look at stocks, mutual funds, ETFs, and so on and so forth. So what I'm going to do, each of these slides is going to provide a definition of what the actual investment is, give a example of what it is, and then again, if there are any questions, happy to answer those as we go through each type, or if there's something else that we want to talk through, we can do that as well.
All right, so I got one question real quick before we move. It says, do you recommend we secure a financial advisor?
So that's a great question. And I think that depends on how astute you are to the market, right? So if you are a person that likes to maybe read the Wall Street Journal or read Fortune or Forbes and stay in connection with what's going on, you may not necessarily need a financial advisor. Okay. If you get a financial advisor, you have to understand that financial advisor is actually going to charge you to invest your money. So there's going to be an expense ratio related to what's going on. But if you are maybe somewhat of a novice to this and you're okay kind of with that expense ratio and you prefer for them to actually invest, do so. But make sure you understand how your financial advisor is actually getting paid, because you don't want your financial advisor having to shift your money all the time or saying, hey, I moved it from this to that. Because each time that financial advisor is moving your money, he's getting paid. But if you're not getting any gain on it, then you're not getting paid.
Okay. That's a pro tip right there. Okay.
Yeah. Now, if you want to invest, if you invest your money yourself, the one thing that I say do is make sure you invest it in stuff that you're familiar with, right? So if you like to shop at Walmart, get Walmart stock. If you like to shop at Target, get Target stock. If you like to wear Nikes, get some Nike stock. If if you like to wear J's, make sure you get Nike stock, because Jordan brand is under that. If you like to, whatever you like to do that you're very familiar with, then get that type of stock, because you're going to be more familiar with what's happening, what's going on in that perspective as well. So if you want to, you can invest it yourself. You can get a brokerage account. You can go and buy some stock here, some stock there, but make sure you also are diversified. So don't just go and buy retail stock related to, Walmart and Nike. Make sure you get some healthcare. Make sure you get some energy. Make sure you get some technology. So you also, if you're going to do it yourself, just make sure you diversify.
As I was going to ask you, so when you speak to diversifying your portfolio, what would you say are probably the best avenues or things that you want to make sure you have in that portfolio?
It's a good question as well. So what I would say is you want to have what I would call your basic living needs. And a lot of people kind of go to Maslow's hierarchy of needs, but I think if you're looking for uh, something that is food wise, we all have to eat.
Okay.
Something that is retail wise, especially within our community, we all like to, dress relatively nice, kind of have some, nice threads here or there.
We
So I
big
think that
spenders
those
now. We are definitely the big spenders.
really big spenders. Um, I think healthcare costs continue to rise. It's always going up. So you want to look into that space. You also want to look into technology. Right now, Matt, you were in Alabama. I'm in Texas. We got people kind of from all over the Southeast that are in. 20 years ago, we wouldn't be able to do this electronically like this.
Right.
So
Right.
that's another space that you want to make sure you take a look at. Uh, and then what I would say is once you look at those technology and then energy, because we are always using gas, we're always using coal, we always
Yeah.
using utilities. So those are kind of my four basics that I would say. So
Okay.
again, healthcare, retail, technology, and energy are kind of the four basics for sure.
Okay. Um, Another question. What about investment avenues? Who is safe to utilize?
So if you're looking at investing, I would say you could do it a lot of different ways, especially when you're going to get a brokerage account. If you have an account with a bank, look to see if they have an IRA and or a brokerage account through them, and therefore you kind of feel safe with the bank or a credit union. If you're trying to look outside of that, I would say my recommendation is Fidelity has a phenomenal platform from a
Okay.
brokerage account. Merrill Lynch also has a very strong one as well. Merrill Lynch merged with Bank of America a few years ago. They have a pretty good platform. SoFi is also another one that's out in the space that is very strong. And SoFi's platform actually has you to look at not only your banking and your checking and your investments, but also your debt and try to make sure that you are actually consolidating that debt or getting rid of that debt as soon as possible to actually be able to grow your investments. So those are very strong platforms I would say you can utilize.
Okay. All right. I'm gonna slide in one more question before we get back to the slides.
Yeah, go ahead.
It says if I already have an account with with equitable handling my portfolio, is there any need to invest on my own?
So if you have someone that is actually handling your portfolio, you can you can invest on your own. I would say again, you have to understand what that person is doing or what that company is doing as a part of your investments. But I would always say everyone should try their hand at investing on their own.
Okay. Okay. So you recommend, now see another side question, E-Trade.
E-Trade's a good one as well.
Okay.
E-Trade's an online trader. They're pretty good. So yeah, E-Trade's a strong platform as well.
Okay. Someone else says, and this is the last one, I promise, before I let you get back to the slide.
No worries, no worries.
Um,
This,
is it,
this, this is what it's about. So throw whatever questions come up, happy to
okay.
answer.
Okay. It says, I have an Empower Premier Roth IRA. Is that a good one?
A Power Premier Roth IRA. So let me step. So when you have an IRA, there are two types. You can have a traditional IRA, which means that funds are taken from your gross income and
Okay.
put into an investment account. And if that's the case, then they can grow tax deferred until you actually retire or of retirement age. The thought there is that once you're of retirement age, you're able to pull out those funds at a lower tax bracket.
Okay.
So that's kind of how the traditional works. If you have a Roth is going to mean after tax. So that means you've already paid tax on that money. So any growth on that money is deemed to be after tax as well. If you have a Empower Roth IRA, that's good. That's very strong. I encourage everyone to have both a traditional and a Roth because what you want to do is you want to be able to expand from that tax code, be able to make money both from your pre-tax income and your post-tax income. So having a Roth is good. Also, one thing I want to also mention is if you're working for a company and they have a 401k and you're not contributing to that and the company matches money, you're missing out on free money. So if your company is matching 1%, 2%, 5%, whatever it is, at least put that money away and allow your company to match that, because the 401k, the IRAs are a substitute for the old pension plan. So when our parents were working, they had a pension plan, and whenever they retired, they were able to get money from that pension plan. As we're working now, we don't have that a lot of times unless we are in government or we're or anything like that. So being able to have your company match what you're putting into a investment vehicle, such as an IRA or a 401k, that's definitely great. You also want to make sure that you're getting that money as well. You don't want to miss out on that money.
Okay. All right, we can jump back into the slide now.
All right, no worries. All right, so the first type of investment that's out there, and this is considered to be a less risky type of investment, is a bond. A bond is a debt security, typically by a government or a corporation that is issued to raise debt. When you invest in bonds, you're basically lending money to that organization, and they are going to pay you back with interest. So there are, from a governmental standpoint, there are bonds out there to build roads, bridges, to build utilities. And they have a certain interest rate. So, you give them $1,000, they're paying that 6%. They're going to pay that to you, monthly, quarterly, semi-annual, or annual. They're going to hold that for a certain period of time. You're going to gain that interest between that, and then they give you your investment back. There are also what are called zero coupon bonds. Let's say it's $1,000, but it's zero coupon. The interest rate is built in. So ultimately, you purchase it for a amount that's cheaper. So let's say you have $1,000 bond, matures in 10 years at, a percentage. You may end up only paying like $400 for that bond, but then in 10 years, you're going to get the $1,000 because the interest and the principal is ultimately accrued for that. So a bond is a less risky type of investment, but one that ultimately has fairly strong interest rates. Again, not the same, when we start talking about stocks are a little bit more riskier. So therefore, you could sometimes usually make a little bit more money on stocks, but bond are definitely a way to go. And it's a way to kind of offset. If you're going to invest in a stock that, you may feel a little risky about, then maybe get some bonds as well to kind of offset as well.
Okay.
All right. Next one are stocks. So, what I want to pause here with stocks is a lot of times when we were talking about stocks, we're talking about, the various, Nikes of the world, Amazons, so on and so forth. But I also want to make sure we understand the types of stocks that are out there. So when we talk about common stock, that's the stock that we can go and trade that ultimately is ownership within a company. But also make sure you look out for a preferred stock. So preferred stock, it has priority if a company were to liquidate or to dissolve. So preferred stock gives you the ability to make sure you're getting your money out of the company, and it's typically a safer investment. So if you have the opportunity to get in on preferred stock, definitely think through that as well. But common stock is also good. You have ownership rights. As the company grows and as the company makes money and puts that back into themselves, you'll see the stock appreciate from that perspective. So, but just wanted to make sure we understood the difference between common stock and preferred stock as well.
Okay, quick question. One said buying saving bonds for my kids. Is that still a good idea?
Savings bonds for kids are always a great idea, because what you can do, savings bonds are very similar to that zero coupon bond that I mentioned. You can go and buy a savings bond. You can get $1,000 bond for a kid very cheap, especially if you're looking to hold that for 10 or 15 years or whatever until they get of age to actually handle money. So that's definitely a good way to go, to also teach kids about money. So, one thing that my wife and I have started to do is instead of buying, a pair of shoes or giving cash, we'll give them a savings bond, right? So now they have to hold on to that bond for 5 years or 10 years, knowing that at that point in time they have, an increased amount of money as well. So that's a good way to give a gift, and also to teach kids about money as well.
So let me ask you a question. So how do they feel when you present that as a gift?
I think it's a learning opportunity for them for sure.
Okay,
Um, so we try to balance, right? I think
got you.
in everything you got to balance, So we may give them, you know, may get a pair of kicks and a savings bond, right?
Okay, got you.
Instead of two pair of kicks, you may have but I think you also have to educate, right? We're trying to one build generational wealth,
Right,
and we're
right.
also trying to get out doing the same old, same old. So our counterparts that have a little bit less melon in their
Got you.
skin, that's what they do, right?
Exactly.
They're building that
Exactly.
wealth, and they're giving that type. So we want to make sure that we're building that for sure.
Okay. All right. Another question before we jump back into the slides. Are Series 1 savings bonds still more lucrative than EE Series savings bonds? Is that Series I or 1? I'm not sure, but you know.
Yeah. So they typically they are. What I would say is, as you're going into looking at the savings bonds, look at the rates. There's always kind of an exception to the rule depending on the savings bonds, but look at that rates. Make sure you're comfortable with that rate. If you're comfortable with the rate and the term, then definitely go ahead and invest in it for sure.
Okay.
All right. Any other questions?
I think we're good. Yeah, I think we're good for a second. I'll let you get back to the slide.
Okay. All right. So the next vehicle are mutual funds. So mutual funds are a pool that have both stocks and bonds. They are very similar to ETFs, which we'll get into in a second. And mutual funds are typically what your 401ks and IRAs have. So, depending upon your age, when you get into a 401k IRA, if you kind of go with the default, it puts you into a mutual fund, which has a little bit of stocks and bonds. And it says, hey, you're going to retire in 2050 or 2055. And it's usually put together by whoever that company is. So if it's a Merrill, if it's a Fidelity, what it's meant to do is be able to provide you what is deemed to be a solid investment in the future. So if you're not sure on a particular stock, if you're not sure on a particular bond, you can just jump into a mutual fund, which is kind of a collaboration of the two, and that can provide you a means to invest in as well. One of the main things I want to highlight, though, is that mutual funds differ from ETFs, that they trade typically at the end of the business day. So if you're trying to get into something during the day or you see a certain price that you're trying to get in, you may want to go with an ETF versus going with a mutual fund, because the mutual fund is going to actually trade at the end of the business day.
Okay.
There's on the left hand part of that slide is just a depiction of how a mutual fund actually works. So you are deemed to be the investor, which is at the top there. You have a fund manager that's putting those securities together, and then you ultimately get the returns that come back to the investor. So want to kind of show that because that gives you a visual illustration of exactly how a mutual fund works.
Okay. Question here. What is the smallest amount I can start a retirement account with if a 401k is not offered by my company?
So that's a good question there. That's going to depend upon where you start your IRA or 401k at. So if you go to your bank or your credit union, usually it's somewhere in the neighborhood of $250 to $500. Some banks or credit union may ask for $1,000 to start off, but that's usually the minimal amount to get into a IRA, Roth IRA, or 401k outside of your company.
Okay. Okay.
All right. Now we look at it, looking at exchange traded funds. An ETF, as it's called, has both securities, very similar to what we talked about with a mutual fund. So both bonds and stocks, may also have other types of investments embedded into it. What ETFs do a lot of times are they usually track directly related to various indexes. So that's going to be the Dow Jones, that's going to be the S&P 500, that's going to be the NASDAQ. So they ultimately try to depict exactly how the market related to those indexes are going, and they try to make sure that that exchange traded funds tracks that as well.
Okay.
Again, these are very common to trade in. If you have a brokerage account like an E-Trade that was asked earlier, or a Fidelity account or whatever, you can go in and get into a exchange type traded fund that has a combination of both stocks, bonds, and other types of investments.
Okay.
All right. Next slide. Another vehicle is real estate. So if you have a home that you may be looking to rent out, or if you're looking to get into kind of the rehab, there's a lot of HGTV shows where you kind of go and you're trying to flip a house and do this and
Right.
do that. That does take a lot of money up front, but it definitely could be worth it. It is a little risky, but it's definitely worth it if you're able to go into and buy a house for 30,000 to 40,000, make some improvements. Let's say you're handy, you're good with your hands, you know how to do electricity, you know how to do plumbing, things of that nature, and you're able to then kind of make the renovations necessary and then resell it or rent it. Definitely, real estate can be an investment for you. Let's say you're not good with your hands, but you like real estate. You can definitely invest into a what is called a real estate investment trust, or a REIT, very similar to kind of the ETFs and the stocks. So you can invest from that standpoint. There are a lot of companies that go around and actually buy land, build apartments, build condos, and the way they're doing that is through investments as a part of a REIT. So wanted to make sure that that's also available to you. That's also a part of brokerage type accounts, IRAs, 401ks, and so on and so forth.
So how sound is that lane? I'm asking because I enjoy real estate. So
Okay.
that's the question for me. Like, how sound is that when you say investing in a REIT? Of course, I know in every city you have a lot of development going on. So yeah, the bottom line, how sound would you say that investment is in comparison to some of the other investments that we've mentioned?
Yeah, so any investment is going to have some portion of risk.
For
When
sure.
you're looking at a REIT, you want to look at maybe where that company is investing in, where they're looking to build in, what type of structures they're looking to build. Are they looking to build residential homes? Are they looking to build condos? Are they looking to build apartments? Are they looking to build commercial real estate? So you want to make sure that you understand what they're looking to do, but it has its element of risk, but it also has its element of reward. So if you're comfortable with where they're building, so if you have a REIT that's saying, "Hey, I'm going to go build a commercial building in Boise, Idaho," well, if I do my research and I see that Boise, Idaho is one of the fastest growing cities in the U.S. right now, that's probably a good sound investment.
Okay.
But if I see that it's building in Burlington, Maine, or Burlington, Vermont, I may be a little bit more hesitant to do that
Right.
because not many people are moving up into the Northeast into the cold.
Right.
So I probably would invest the one with Boise versus the one with Burlington.
Gotcha. Okay.
If we go to the next slide, so I know a lot of people usually have questions around this. Crypto is one of the things that is fast moving, fast growing. One of the things that a lot of people are hearing about, crypto mining. You go to get your haircut at the barber shop, and the barber's like, "Hey, I know I got this crypto guy here," so on and so forth. So you got to be careful with crypto. Crypto is a digital currency by way you can buy and sell goods. I've noted just a couple of big ones. I think everybody's heard about Bitcoin, Ethereum, Litecoin, and Ripple.
Right.
Um,
Right.
Crypto is very volatile. So you'll see what I have there in red that, before you invest in crypto, make sure you know what's going on. Crypto is deregulated, meaning that the government there's not the government nor there's an agency that is overseeing crypto at this point in time. So it's you can if you want to say it's pseudo black market or whatever the case is, but nobody's regulating it. Um, you understand when you look at Bitcoin. Bitcoin had a high of about $64,000 back in November of 2021, and currently it's now around $23,000. So there's a lot of volatility in crypto. Is crypto the wave of the future? There's definitely a strong possibility. There are a number of countries, especially China, that's looking into digital currency. Behind the scenes, the US is also looking into digital currency. So digital currency is definitely one that is probably some form of the wave of the future. I think if you think about it, the fact that a lot of us have phones when we're using Apple Pay and things of that nature, that's a digital type platform as well.
Right.
So just be careful. It is a way you can make money. But it's also a way you can lose money. And the risk right now is definitely very high. So if you're thinking about crypto, make sure you understand there are some brokers. I mentioned a couple of them. There are Charles Schwab, TD Ameritrade that won't allow you to purchase crypto just because of the risk that's involved.
Wow.
But you just got to be, if you want to do it, you're able to do it. There are some brokerages that will allow it. Robinhood is one. So just noting that from that standpoint, if you're looking to do that, but just be careful with it. Also be mindful, be prayerful about it as well as you're going through to look at that type of investment.
Okay.
Last one on the list are commodities. So this is gold, silver, things of that nature. Very strong investment vehicle types. I think kind of before our time, some people will remember that the actual dollar itself was backed by gold. And so people still believe in gold, having gold bars as an investment. So gold is very strong. I think it's up until like the 1900 per ounce or so right now. So it is a good investment. It's a solid investment if you're looking at commodities such as gold, silver, mercury, that type of thing. So just make sure you understand what's going on from that perspective. But commodities are very good to get in as well.
Okay.
And as we're talking about investments, I just want to kind of make sure to leave with the scripture again. We're making sure that as we're talking about the financial checkups and having these financial seminars, that we also always have God involved in it as well. So the scripture,
Absolutely.
the Lord shall open up unto thee his good treasure, the heaven to give thee rain unto thy land in the season, and to bless the work of thy hand, and thou shalt lend unto many nations and shall not borrow. So as we believe the word of God, as we believe and obey into what we're being taught and what we're being asked to do, that God will shine upon that and he will allow our investments to grow. And we will not be in debt. And so therefore, from that standpoint, we would lend to nations and not borrow.
Abe, I love how you just lace the word right. Like I love that. They would have thought that we told you to do that, but we did not. I love how you put that in the presentation, man. For real. Seriously. But I got a side question real quick. Would you suggest staying in a moderately aggressive IRA if you're over the age of 65?
Good question. Usually what financial advisors or financial planners will tell you is you should be more aggressive as you're younger. That way, if you lose any type of money, you have time to make it up. Once you are actually older, they say you should start to have less risk. It depends on how comfortable you are. If you're over 65, if you have other ways of income to come in and you're just, you want to be a little bit riskier from an IRA standpoint, I would say do it. If you're counting on that to maybe pay some bills and do some other things, then I would say you probably want to be a little bit less risky and kind of stay closer to the bonds and stuff like that may have a lower rate, but is also going to give you money and interest. But if you have other way, let's say you have a pension coming in, or you got some investment property coming in with rent and stuff like that, then you may have an ability to be a little bit more aggressive there.
Okay. Another question. A lot of people are somewhat intimidated by investing. What would your advice be to help them out getting started?
I think the one thing to do is when I went back and talked about the emergency fund. I think when you start to put, you think about your expenses and you put that into a money market or something like that, and you're gaining 4 or 5%, and you're seeing, let's say your 3 to 6 months is $10,000, right?
Okay.
And let's say you're at 5%, and at the end of the year, you see that that has grown by $500, and you haven't done anything, and you just had that money sit there, and now you're at 10,500. I think people start to say, okay, well, I can definitely do this.
Right.
As you start, the other thing I would say do to try to help ease that intimidation is on your phone, uh, especially if you have an Apple device, you can go in and put stocks into your phone and just watch those stocks. If you're scared to actually put money in them, then just watch them for a few weeks or a few months and see how they grow. Just, whatever you may be interested in, just uh, put that ticker symbol in and watch it. And then that'll give you more comfort on, okay, well, I can go invest in Under Armour. I like what's going on. I like what they're doing. I like that they have Steph Curry. I like that they have Joel Embiid. Like that they got Tom Brady. So you're able to watch different things and kind of gain comfort from that perspective. So those are two ways I think for sure you gain uh, ease to not be intimidated by investing.
Okay, so I got another question. So this is for somebody new. Like, let's say you have, because a lot of people to kind of dovetail on the previous question, you have people that have been able to generate wealth over the course of their lifespan, and they just kind of sit on that, right? Like, I've made the money, I'm good, I'm comfortable, we can travel, we can do whatever we want to do whenever we want to do it.
Sure.
But my money's just sitting in a bank, and then like you said, they kind of start to realize my money's sitting in the bank, but it's not really doing anything for me. So let's say they take $1,000. All right. So they're starting today, and they say, all right, Abe, I'm taking $1,000. What would you say? Here's the best option. And I know you can't and don't, I'm not telling you to give a foolproof plan, because we know in investing, there is no such thing as foolproof. Everything, like you said earlier, has its own risk. You just kind of have to understand what you're getting into. But if they said, okay, cool, I'm gonna take $1,000 and I'm gonna start with $1,000, for that person that's making that decision, tell them what the best option would be.
So if you got $1,000 and you're trying to look and you're trying to make something with that $1,000, I would say the best option is there something you can do to make that $1,000 grow. So I'll take as an example, if I got $1,000 and I can invest that into myself to start a business, to do something that I know is going to bring some money back, I would say do that first.
Okay.
If you're looking at an investment such as what we've talked about, if you have a stock that you've been eyeing and it's steadily growing, it's steadily improving, the company's having good performance, do that. If you're a little leery of the stocks, not sure what you want to do, but you want to try your hand at something, then jump into a mutual fund or ETF that usually has a balance and usually has shown historical growth from that perspective. So those will be the three things. If you can invest in yourself as starting a business or doing something that you're putting your hands to and it will bring money, definitely do that. But if you want to do something kind of as one of these vehicles, look at the stock. If you're a little leery, then jump into something that's a little bit more balanced with an ETF or a mutual fund.
Okay. And let me ask you this, because I know this is, you have people on both sides of the line of this, but in the times that we're living in now, medicinal marijuana, as it continues to be legalized in states. What are your thoughts on investing in that? Because that field is continuing to flourish. While we may say, ah, man, I don't smoke, I don't do this, I don't do that. Okay, but we're talking about on the investing side of it.
Yeah. So that's a great question, and I would think that there is definitely probably some bifurcation from the standpoint of how different religious institutions look at that. Um, I will say that if you research it, medicinal marijuana has has shown signs to kind of help with pain and pain tolerance and things of that nature. But I think it's also the way it's being, it could be consumed.
Right.
If you are actually, lighting it up and smoking it, that's a little bit different because you're changing the chemical compound of that. Um, but if it's truly an investment you want to invest in, I think you definitely need to pray about that. And if your spirit feels comfortable in doing so, then that's up to you. If not, there are definitely other options that are out there for you as well.
Okay. What are your thoughts and opinions on day trading?
So if you're a person that definitely likes the market, and you stay very close to the market, and you're looking at penny stocks or options and stuff like that, and you're just very in tune to what's going on, definitely try your hand at it. Try it at a small amount of money, and see how well you do. But again, day trading is not for everybody. You just got to make sure you're looking at, and this is kind of being a little bit more detailed, especially when you're looking at stocks. You're looking at PE ratios. You're looking at income, so on and so forth. If you're going to go down that route from a day trading perspective.
Okay. Also, are there any books or people you recommend beginners to read or listen to become more knowledgeable before putting money into an investment?
Yeah, there are a lot of books out there. I think Pastor Judith Matthews kind of listed a number of books that are available, as well. I think definitely those books are sound. There's a
Got a
book,
couple of them. I got a couple of them
a
right here.
couple of them there. Rich
Yeah,
Dad Poor Dad, is another good
that's
book
one of my favorites.
to read. And then you could just do, being able, just utilizing Google. If there's a particular stock, if there's something that you want to look at, that's also a very strong way to understand what's going on, from that, from an investing standpoint in general.
Okay. Okay. Bet. We can jump back into the slideshow now.
All right. Well, I think that the scripture was my last one, and then just
Okay.
open for any other questions.
Okay. While they're generating some, I will ask you this. Um, is there, well, let me ask you this. Is there such thing as a safe investment?
So there are stuff seen as a safe investment. I think the bonds are safe because you're going to gain money. You may not gain as much money as a stock,
Okay.
but it's safe and you're going to get your principal back. The money markets, the high yield savings and checking accounts, those are definitely safe investments where you can get uh, interest on the money there, and you're not at risk of losing your money. But if you want, higher returns, there's the risk of that you could potentially lose your money there. But if you're looking for something just safe, I'm going to gain some interest, um, then definitely bonds, money markets, high yield savings, high yield checking.
Okay. Is the conservative profile fund investment good?
Conservative is good if that's where your risk tolerance is. Conservative is also good if you're later in age or up in age. But I would say if you're younger, you still have 15, 20, 30 years to work before you retire. I would definitely take some risk. So the more risk, the more reward.
Okay. As an investor, what would you feel are economic cues that I should really pay attention to? I.e., for instance, let's just talk about we're in quarter one of the new year. And I know we were talking about the tech space earlier. And
Yeah,
the tech space has been doing a lot of changing right now as far as letting people go,
sure.
and things like that in that space. So, what are kind of cues that you think I should pay attention to when it comes to investing as far as what's happening in the economy?
So I think with tech, you definitely want to pay attention to the layoffs. I think what happened there is with COVID, tech kind of thought that they could bring on more people than they seemingly needed. And as rates started to move up, they had to let some people go. So I would definitely, I think tech in general is one that's going to uh, kind of defined what's going on in the future. So I would say definitely tech. I say the others, you want to pay attention to the Federal Reserve. So the Federal Reserve is the governing body here within the U.S. that actually raises rates, because they're ultimately trying to stamp out inflation. So you want to look at inflation, you want to look at rising rates as different cues on what you can potentially invest in, or kind of what the market is doing in general.
Okay. Another one. What is considered a good or average return?
So right now, I would say a good or average return is probably in the neighborhood of 6 to 7%, and that's probably right there uh, around your CDs area. I think anytime you can go and make double-digit returns, kind of 10% or higher, then that's what you're looking for. That's what you're talking about for sure. So, and
Okay.
again, that's gonna take a little bit more risk than like your CDs and your money markets. But when you can get into that double digit 10, 20, 30%, that's definitely what you're looking for year over year.
Okay. Hey, so listen, we're definitely over time. So I want to give you a chance to any information, just kind of like to go information that you want to bundle up, or something that you want to just leave us with, just to kind of culminate everything we've talked about kind of in this forum today.
Yeah, I would say, from a educational perspective, from making sure that you are in tune to what's going on. If you're not, looking at the market on a continual basis, definitely do so. Look at, get a magazine like Forbes or Fortune. Black Enterprise also does a very good job of providing sound financial advice, especially for people of color. And then just make sure that you're just paying attention. I think the more you're informed, the better the decision you will make overall. And by doing so, you're also able to pass down things to your kids, your grandkids, and others as well. So that's one thing I want to make sure that you take away from that, is doing that. Just making sure you're staying in tune to what's going on.
Okay. All right. Well, hey man, I listen. I appreciate you. It has been a pleasure to have you on and just kind of share the wealth of knowledge that you gained over your years of experience, man. I promise you, I appreciate you. And based on the questions and words in the chat, they appreciate you too. It's much appreciated, man. Of course, and we covered it earlier. Like, we don't necessarily just have these open forums for us to be able to kind of ask these questions in kind of a one-on-one, like you see it on TV. But like, man, I need to talk to somebody and ask them some questions. So I appreciate you taking time out of your day to kind of share with us and just kind of open your mind to us to ask you questions and pick your brain on everything. Thank you. I appreciate it.
Yeah, I'm humbled. I'm honored to do so. And anytime there's a need or anyone has a question, I'm available.
Okay. All right, man. I appreciate you so much, man.
All right. Thank you guys again.
Yes, sir. To everyone else, thank you so much for tuning in for another segment. It has been a fantastic week. If you missed anything or you want to go back and see anything, you can always check out the YouTube channel. Everything is available on there. You can watch it from start to finish. And let us know how you felt about everything. We're kind of kicking around some ideas for some other things like this. So let us know kind of how you felt about this across the board. This is something we may want to keep going and really push to kind of grow, because you should consider this week as the seed for everything from Monday to today, Friday. You should consider it as a seed. So now you've got notes, you've got something to plant. And so now it's time to build upon everything and kind of start to put a lot of these different principles and things that we've gained into work. And so once we revisit the subject, now we went from level 1 to level 5. So let us know how you felt about everything. We're glad you took time to tune in and check us out. And we will see you guys. Hopefully, we'll catch you guys in service this weekend. Be blessed.